Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada's economy shrank at the end of last year. StatsCan saying gross domestic product fell 0.6% in the fourth quarter, led by a sharp decline in business inventories. The decline was partially offset by increased household spending and exports. For 2025, GDP rose just 1.7%, the slowest pace of annual growth since 2020. We got some insight on what that data might mean for the Bank of Canada.
That's 2 quarters out of the year where we saw the economy contract. Back in the second quarter, obviously because of the trade war, but it does appear that ongoing uncertainty about trade policies continuing to weigh on business investment. This number is a little weaker than the bank was anticipating, but not weak enough to spur another rate cut. I think unless the economy shows more sustained weakness, or the labor market shows sustained weakness, I doubt very much the Bank of Canada is inclined to cut rates.
China will begin halting tariffs on Canadian canola starting next week. The move comes after Prime Minister Mark Carney's visit to China in January, where a deal was discussed to drop tariffs on canola, peas, lobster, and crab in exchange for Canada cutting tariffs on Chinese EVs. However, how far those tariffs will fall is still uncertain, with Carney hinting they could drop by about 15%, though final details have not been confirmed. Shares of AtkinsRéalis are in the red. That's after the engineering firm gave a full-year forecast for profit and cash from operating activities that fell short and disappointed investors. Some analysts are also noting a higher-than-expected lump sum project loss, as well as a miss on capital revenue. On the bright side, Atkins says demand for its service and nuclear products remain strong, leading to a record high backlog. And a quick look at the markets after a strong week. It looks like the TSX is going to end on a down note. It's off by 0.55 right now, but still well above 34,000. Tech is what's driving the markets down right now. South of the border, similar situation. Everybody in the red. There's been a little bit of a bounce back, but still, everybody in the red. The S&P 500 off by 0.54, the Dow by more than a point, and the Nasdaq is off by about 0.7. The Canadian economy ended 2025 with a slight decline. Preliminary estimates from Stats Canada suggest real GDP will remain unchanged in January as well. Here to provide some analysis on the data released by Stats Canada is Claire Fan, senior economist at RBC. Claire, thanks as always for joining us.
Thanks for having me.
What number stands out for you the most?
I think the overall sort of headline GDP decline of 0.6 annualized rate is definitely eye-grabbing, but the underlying details, again, if you were to look at spending by Canadian businesses, by Canadian households, and by Canadian government, they all look pretty healthy. So I think rounding out the year, 1.7% growth for 2025, considering the headwinds that, the Canadian economy was facing last year, record slowing population growth and a historical trade shock, I think the growth rate itself tells the story of Canadian economic resilience.
And what does this mean kind of heading into 2026 then? Are we on the downward? Are we on the upward? Or is it still hard to read?
Yeah, well, we're still cautiously optimistic about the Canadian outlook, economic outlook this year. I mean, one of the key headwinds that I was talking about, population growth, according to PBO's estimates and our own, basically for this year, is still that it's going to be quite slow. It's going to be flat, essentially. We're not going to see a ton of population growth, and that's largely just driven by the government's sort of changes in immigration policy. But the second headwind, trade uncertainty, certainly felt like it it was perhaps escalating over the events over the last weekend. But actually, if you were to look at some of the details, one of the key things that we continue to point to is CUSMA exemptions. And that was the key question, was were those exemptions going to hold against the new tariffs, new U.S. tariffs? And they did. So all of those key assumptions kind of leading into our continuous sort of assumption that a lot of these headwinds may be kind of unwinding a little bit for 2026. And couple that with sort of the resilience in the Canadian economy that we talked about just now in 2025, we think it's going to be we're cautious obviously about that outlook, but so far we're still pretty optimistic about the Canadian economy.
And has CUSMA been a lifeline for our economy right now?
Absolutely. So CUSMA, to basically paint the broad picture, is shielding around 90% of what Canada exports to the United States from U.S. tariffs. And that includes the new Section 122 tariffs, 10%, that was just imposed last week. That was later threatened to be raised to 15%. But certainly that is one of the most important assumptions that we do have as well, is that heading into sort of the review process starting in mid this year, we're going to continue to see those exemptions remain in place.
All right, and just kind of going back to the quarter that we just saw, one of the worst since the pandemic.
Yeah, so the quarterly decline was definitely, pretty substantial. But if you were to look at sort of the production side of things, we've been pointing to tariffs sort of impacted sector. A handful of manufacturing subsectors still really saw production. Actually, manufacturing GDP dropped by over 6% on an annualized basis in the fourth quarter. So the sectors that are impacted and targeted by U.S. tariffs, without a doubt, were still underperforming. But the catch there is the rest of the economy. So it doesn't appear to us that any of that weakness in any way has spread to the rest of the economy. And that's sort of the good signs that we're still sort of cautiously anticipating will be the case this year as well. And finally, the last thing to mention here is that rounding out the quarter, the last monthly print was actually pretty positive. It was 0.2%, almost nearly to 0.3%. So a lot of the softening was really tied to earlier on in the quarter, and we started to see some improvement actually as we get late into Q4.
One of the things we saw, wages rose, I believe, in this last quarter. Any concerns about inflation with that?
Yeah, so that's a good question. Wages has been coming down broadly, and if you were to read any sort of business survey out there, including sort of the Bank of Canada's own survey on business conditions, I think broad concern on hiring and capacity constraint is still very absent. We're not seeing any indicator or any indications of Canadian businesses saying we're having difficulties in terms of hiring workers, and that lends to sort of this expectation that wage growth in Canada should continue to moderate, even though it's taking a bit longer. So yeah, the year-over-year number is a bit stronger still, where it's been moderating quite slowly. But frankly, given sort of the inflation shock that we saw over the 2022 and 2024 period, if you were to really look at the aggregate wage measure versus inflation measure, we're still seeing actually pretty subdued real wage growth.
And for the bank, where does it leave it when it comes to either rate cuts or rate hikes?
So the Bank of Canada made it pretty clear. I think they're pretty comfortable with where rates are currently, borderline stimulatory levels to 25%. And I think today's report, again, the headline's a bit softer than expected, especially comparing to the bank's own sort of forecast for the quarter. But the details certainly do not sort of speak to the need essentially for more central bank easing. And that's, I think, our expectation as well as consensus is that there really is no additional sort of need for the Bank of Canada to be further easing rates, even though actually inflation in Canada has actually been pretty soft. So should the Bank of Canada need to cut rates, they definitely do have the room to do that. But today's growth report just speaks to, there's really no need essentially for additional easing from monetary perspective.
Okay, and just one last question. I just noticed it as government capital spending jumped by 20%. How much of an impact is that having on the overall picture, and is it healthy for the government to be spending that much? I know it's stimulus, but is it good the government spending that much?
Right. So that's a great question. So for a long time during 2025, we kind of spoke about this handover from monetary policy to fiscal policy to essentially really help curb the economy from, just in terms of dealing with the trade shock. And that's a really great question. I mean, cyclically, in the near term speaking, it's definitely not healthy. I think we're seeing some of the provincial governments as well posting pretty large sort of deficit projections yesterday from Alberta, including. But over the long run, if you were to think about, again, sort of Canada's broader priority, especially the most primary priority is to diversify our trade away from the United States. And that does entail a lot of infrastructure spending in the near term. So for that to facilitate that process, to better our ports, better our infrastructures, to enable that export capacity. So it is a little bit of trade-off in terms of short run, fiscal sustainability versus long run priority in the economy. But that's certainly what we're seeing this year.
Okay, Claire, we'll wrap it up there, but thanks as always for joining us.
Thanks, Roger.
Claire Fan is senior economist at RBC. Up next, Netflix has withdrawn its bid for Warner Brothers. We'll find out why it could be a win for the streaming service after the break. Shares of Netflix have surged this morning after it dropped its bid for Warner Brothers, clearing the way for rival bidder Paramount to clinch its multi-billion-dollar deal for the historic Hollywood studio. Here to explain why this could be a win for Netflix is Alicia Reese, Senior Vice President of Equity Research at Wedbush. Alicia, thank you very much for joining us.
Thanks for having me.
I think, could this be a win for viewers too? We might see more content out of this.
Yeah, it certainly. Netflix has already committed to 20 billion in content spend in 2026, whereas its prior commitment was 17 billion. It has 2.8 billion that it's getting from Paramount for breaking up the deal, and they have a lot of opportunity here because their competitors are going to be tied up in this regulatory scrutiny for the next several months, and they have a lot of content out there to go after. And yeah, I think that's going to be a win for consumers.
All right, let's talk a little bit about the deal that wasn't now. Why did Netflix pull out? Was it simply getting too expensive and not worth it?
Yeah, Netflix's primary commitment was to its shareholders, and the deal was a positive one. They were going to be able to leverage all of that amazing Warner Brothers content against their new ad stack and grow that meaningfully globally. There was a huge opportunity with theatrical in opening that market, but the pushback they were getting from Hollywood was becoming quite cumbersome. The price tag was the ultimate deal breaker, though. They weren't about to overpay for it, and at this point, they were going to have to overpay. And they didn't let their egos get in the way. They were absolutely committed to their shareholders. And they saw, based on when, Paramount came in for the deal, that their shareholders were happy, that there was a possibility that they would not go through with the deal. And so they didn't, they were committed. And I think that shows great restraint.
And what kind of a role did politics play on this? Was there any, do you think? I mean, there were all kinds of, there was a flurry of meetings.
More than you would like.
Yeah. Okay.
More than anyone would like, I think. Unfortunately, that's just a simple fact. The regulatory process could be lengthy anyway. And there were plenty of arguments against Netflix in the regulatory process anyway. With the market share arguments, it's a tough argument to make that YouTube is in the same market. There are some arguments for, many against. And I think that would have gotten hung up for quite a while. Ultimately, though, some of the friendships between Paramount and the White House might accelerate the regulatory process for better or for worse. I do think they'll still get hung up in regulatory over CBS and CNN potentially combining. They might have to create some remedies there, and then you have the CFIUS review that may or may not go through more seamlessly than it would have otherwise.
All right, and let's stay with Netflix. Where do they go now? We were talking about content. Is that what their focus is?
Their focus is on content and advertising. Those are the two main opportunities. They haven't gone big into live events yet, and they have a lot more opportunity to dive deeper into that. But they're really, really frugal with this. They're careful. They don't go and spend, lavishly on all these big sports properties. They're very, picky about what they choose, and what they have chosen so far has worked really well for them at great price tags. They also have this immense opportunity with advertising. They're in the very early innings of growing that, and they can double their advertising to $3 billion this year. That's just the very early stages, and they can, really expand that globally and leverage all of their content globally, their ad stack globally. There's just so much they can do. So with or without the deal, Netflix had a huge opportunity, and their share price recently hasn't reflected it, and we expect it to again soon.
I mean, I was just looking, I think they're up, doing the quick math, 10%, close to 10%,
Yeah,
a little
10%
under right
today.
now. Yeah, 9.3. It was some quick math there. And with the live, I mean, what do you see them possibly going for with live? You said they're picky, but is there anything that they might have an eye on?
Yeah, I mean, they didn't go for the Men's World Cup, but they did for the Women's. They go for a couple NFL games here and there. There are certainly more NFL games they can go for. One-off events are great for them. Boxing is really great. They, went after UFC. The price tag ended up being too high, so they pulled back on that, similar to this deal. They're just going to go for the right kind of content that works for the price tag. What I think will be really beneficial for them is to take international sports outside the U.S., outside Canada, and really grow those to a large extent by leveraging that against their global audience. They've done that with a lot of Korean content, let's say, and they can certainly do that with sports. Let's have some Aussie rules football for a change.
It sounds like they kind of like, to a degree, cheap and cheerful. They want good bargains.
Yeah. Yeah, and they're very profitable as a result.
I'm just going to bounce again back to Paramount with CNN, and what do we see happening with CNN with this? Could there be a merge, or could they be forced maybe to sell it off?
Yeah, they might be forced to sell it off. That might have to be a structural remedy that is forced upon them. I'm not sure in this particular environment, but with the scrutiny that was promised to Netflix, I would be surprised if there wasn't, at least some deep level of scrutiny against this one as well.
All right, and big picture, any other mergers on the horizon right now, or is this about what there is? Was this the opportunity?
Well, yeah, I mean, Warner Brothers was distressed just because, I mean, they had some amazing content out this year. Pam Abdi and Mike DeLuca have done a phenomenal job on the theatrical and, content buying side. People are watching their content and loving it. So I think they're really healthy on that side, but they just had a lot of debt that they're still trying to work through and trying to, cut their way to prosperity, which is tough in this business. You have a lot of other studios that could potentially be up for sale. Sony may eventually, get rid of their studio arm. You have some smaller studios. You have Lionsgate still up for grabs potentially, and then you have smaller studios like A24 that are really seeing a heyday, putting out tons of good content.
And if you were a betting woman, any of them that you'd pick? I'm gonna put you on the spot for a sec.
I mean, if I was Netflix, I'd go after A24 personally.
All right, we're gonna wrap it up there. Alicia, thank you very much for joining us.
Thank you.
Alicia Reese is Senior Vice President of Equity Research at Wedbush. Up next, we're watching the price of oil today as traders consider the threat of a U.S. strike on Iran following stalled progress in the Geneva negotiations. We'll have more on that when we come back. Technical talks between Iran and the United States will take place in Vienna next week as both sides continue to seek a diplomatic resolution regarding Iran's nuclear program. For more, we were joined earlier by Halima Croft, Head of Global Commodity Strategy at RBC Capital Markets.
They've already done military exercises in the Straits. We have seen in 2019 that one of the first things they did after the U.S. reimposed sanctions on Iran was to attack tankers off the coast of Fujairah, the UAE. And so I do think, even though they probably cannot close the Straits of Hormuz, that all-important critical waterway for the transport of oil and products, that they could absolutely mine the Straits. They could attack individual tankers. So I would look to the Straits. And then again, I think we should be thinking about, UAE's oil infrastructure, Iraqi oil infrastructure. again, I think that they have the ability because of their missile capabilities. Their short-range missile stockpiles are largely intact, and so those could be deployed against energy assets across the region.
You've been tracking the big OPEC plus producers who have implemented voluntary cuts and comparing how much oil they're supplying to the market now or recently versus pre-COVID or April 2020. So, for example, Russia is still supplying quite a bit less, or did in January, than it did back then, and the same with the Saudis. So they could, if they wanted, put more oil on the market.
We look at the April 20 production levels as essentially almost potentially near-term peak levels, because April 2020 is when you had a very fierce price war between OPEC and Russia. And so we don't think those producers held a lot back. And some countries have made some capacity expansion since April 2020, like UAE. But we think basically, except for Saudi, every producer is in the market right now. Russia has been suffering significant infrastructure attacks, lack of investment. We do not think Russia has the ability to surge. We think the only country that has the ability to surge is Saudi Arabia. And the amount of production they could bring on would not be sufficient to offset a major attack on an energy facility or a major disruption of transport through the Strait of Hormuz. So one of the challenges for the Trump administration is they were very focused on getting more OPEC barrels on the market the first year in office. But the problem is, if you bring forward that production, you don't have that much left in reserve in the event of a supply disruption. And also, think back to the Russian invasion of Ukraine. Part of the reason why we didn't have a massive supply disruption or run-up in prices was the fact that the United States decided to release 1 million barrels a day for an extended period from the Strategic Petroleum Reserve. We have not rebuilt our SPR. So again, the shock absorbers in terms of spare barrels, everyone's been focused on a well-supplied oil market. But if you have a physical supply disruption, then you focus on what barrels can you bring on very, very quickly to fill the gap. And that's where we have a shortage if we do indeed go to another round of military engagement, and it is more disruptive when it comes to regional oil supplies.
Oh, that's interesting. So the valve can't be turned up that much in the short term. That's very interesting.
Right. U.S. production is not a light switch. Whenever you have a supply disruption, that's the phone call is made from Washington to Riyadh. And again, they've already brought forward barrels. There just isn't a massive shock absorber if we were to get to a serious military conflict in the Middle East.
Andrew was speaking with Halima Croft, head of global commodity strategies at RBC Capital Markets. When we come back, we'll react to last night's comments from Pierre Poilievre, the Conservative leader, on his vision for Canada. That's after the break. The Canadian economy contracted to end the year. Data from StatsCan shows gross domestic product shrank 0.6% in the fourth quarter, driven by a sharp decline in business inventories. The decline was partially offset by increased household spending, exports, and government spending. Overall, GDP increased 1.7% in 2025, the slowest pace of annual growth since 2020. In a preliminary estimate, the agency suggests real GDP remains unchanged for January. Laurentian Bank posted first quarter results that came in below expectations. The Montreal-based lender missed on profit and also reported a net loss of a little more than $20 million. Laurentian says the quarter was hit by costs related to its strategic shift. The lender is transitioning to becoming a specialty commercial bank and exiting retail and small banking. The CEO says the performance reflects a pivotal step in the bank's ongoing transformation. Fairfax Financial is the front-runner to buy a majority stake in IDBI Bank, according to a report from Bloomberg. Fairfax is in advanced talks with the Indian government and is considered ahead of rival bidders. The 61% stake is valued at about $8 billion US. Fairfax was founded by Indian-born Canadian billionaire Prem Watsa, and the deal could mark the biggest foreign investment in India's banking sector. Looking at the markets, a week that has been soaring for the TSX, ending on a bit of a downer by the looks of it right now. It's off by about a half point, still over 34,000. And south of the border, U.S. markets feeling it as well. All of them in the red. The S&P 500 off by about a half, the Dow by a point, and the Nasdaq by 0.8. Dueling speeches yesterday from two key political figures, Conservative leader Pierre Poilievre sharing his vision for Canada-U.S. relations and taking aim at U.S. President Donald Trump, while Liberal Minister Dominic LeBlanc, who is leading the trade negotiations for Canada, gave a rare update on the talks. CTV's senior political correspondent Mike Lecouture has more.
What President Trump says about Canada is wrong.
It's the strongest language Pierre Poilievre has used against the U.S. president to date. In a speech to the Economic Club of Canada, the Conservative leader laid out how he would deal with the American administration if he was leading Canada. He also took a shot at Prime Minister Carney's assessment of the global trading system.
We should not declare a permanent rupture with our biggest customer and closest neighbor in favor of a strategic partnership for a new world order with Beijing.
Poilievre told the Bay Street crowd he wants to negotiate a new tariff-free auto pact with the U.S., an end to sectoral tariffs, the revival of the Keystone XL pipeline, and a full exemption from Buy American provisions.
I think that Canadians are expecting on this an existential issue for many Canadians, a signal from the opposition leader that he has some solutions.
While Poilievre was offering his remedies for the issues with our ally, the minister responsible for trade with the U.S. was giving his own update on negotiations and setting expectations for hard-hit industries like steel, aluminum, lumber, and autos.
But those will be bilateral arrangements, sort of adjacent to would be the bureaucratic phrase, the trilateral trade agreement.
While Poilievre has proposed a cross-partisan team to help with the CUSMA review, it's unclear if the government will accept the offer. Meantime, Minister LeBlanc confirms he will meet with U.S. Trade Representative Jamieson Greer in D.C. next week.
That was CTV's Mike Lecouture. Let's hear more now from Julian Karagassian, lecturer in the Department of Economics at McGill University. Julian, thank you as always for joining us.
Thank you for having me.
A bit of a different Pierre Poilievre there.
Yeah, definitely. And he was quite late coming out of the gate last year, talking about Trump's new foreign and trade policy. And so a year hence, we're seeing something now.
And it's an interesting road. I mean, he's leaning towards the U.S. And saying we can't call it a permanent rupture. Is that a reality? I mean, they are our neighbor, and they are our biggest trading partner.
Absolutely, and they probably always will be our largest trading partner, at least for the foreseeable future. I think Pierre Poilievre had mentioned yesterday that Canada shouldn't be turning away from the United States. I mean, we're not causing the rupture, and we're not turning away from the United States. It seems like increasingly the United States is turning away from the world, and we're reacting to it. They're making trade more uncertain. They're making trade more costly. They have sizable sectoral tariffs on some of our key industries. And so the way I see it in a completely nonpartisan way is I see that the current government is reacting and trying to take a very practical, a very business-oriented approach to trade by looking to diversify our markets, because our entire economic model is based in significant part on international trade, most of which we do with the United States. We've become excessively dependent. I don't think we ever imagined that they would weaponize it. And so I see us as in reactive mode. And I'll leave that there.
And what do you make of his warning that Canada shouldn't swap dependence on the U.S. for dependence on China?
I mean, we've heard that from certain commentators. Now we're hearing it from the leader of the opposition. I don't think we're swapping the United States for China. China represents less than 5% of our merchandise trade. I think we're simply looking to build out our trading relationships with China, with India, with Mexico, perhaps Brazil, Nigeria, more with Europe and the UK to make up for the loss that we are experiencing right now with the United States.
And is that doable? Does it feel like that we can replace the U.S. or what we're losing in the U.S. with all those other countries, which are thousands, in many cases, thousands of miles away?
I mean, I think it is doable. Canada has what the world needs in terms of energy, in terms of critical minerals, in terms of other natural resources. The High Commissioner for India to Canada said yesterday, we'll buy as much liquefied natural gas, oil, and uranium as Canada is willing to sell us. And that's the biggest population in the world. And, China's this manufacturing superpower. Canada's an energy and natural resource superpower. So we could do a lot of business with them as well. I think it's not a matter of swapping out the United States with any particular country. I think we do about 75% of our exports with the United States. If we lose 10 percentage points of that, I do believe we could make that up easy with the rest of the world. It's just going to take time.
And with Poilievre's calls to we should be negotiating towards a full exemption from the Buy America rules, relaunching the Keystone XL pipeline. Are these realistic, or are these at this moment with that government in the States, is it pretty much next to impossible?
I think with the current government in the States and even the previous Biden administration, and if we talk about Keystone with previous administrations, it's been very difficult to restart the Keystone pipeline. With respect to getting tariff-free access to the United States, I don't think that's in the cards with this current administration. I think that they see themselves with tariffs as getting a 2-for-1 to edge manufacturing back to the United States and to raise revenue. Although their own Supreme Court said that they're not allowed to raise revenue with tariffs. But I think they're going to continue down this path.
And is there the possibility, well, I guess we don't know who the next government will be in the U.S. It can't be Trump, at least legally it can't be Trump. Who knows, unless they can change things. Would you see the next American government, even if it's Democrat, continuing with this if it looks like it's working?
With tariffs? I mean,
if it looks like it's working. I know the general consensus is they don't work, but if for some reason it seemed like they were.
I would say this, it's next to impossible for me to imagine any candidate, Republican or Democrat, but even Democrat, running on a free trade ticket, running on a ticket of, let's reverse everything that Trump did in terms of tariffs. If we look back to the Biden administration, they kept most, if not all, of the tariffs on China and certain other countries. They added more. And then with their Inflation Reduction Act, they brought in $1 to $2 trillion of subsidies, which is also an unfair trade practice. And the United States has criticized other countries for subsidizing. So the Biden administration was a massive subsidizer of industry. So I think this is a long-term move by the United States, regardless of Republican, Democrat, away from global free trade.
Okay, we'll have to leave it there. But Julian, thank you as always for joining us.
Thank you for having me, Roger. Take care.
Julian Karagassian is a lecturer in the Department of Economics at McGill University. Coming up, Atkins Real's nuclear push helps drive fourth quarter revenue and profit beyond expectations, but investors remain wary. Our next guest breaks it all down for us. Shares of Atkins Realis Group are sliding today, even though the engineering firm reported fourth quarter profit and revenue that beat estimates, off by about 1.57 right now. The drop comes as investors raise concerns about the company's outlook. To help us break this all down, we're joined by Maxim Sytchev, Managing Director at National Bank Capital Markets. Thank you, as always, for joining us, Max.
Good to see you, Roger.
All right, let's talk about the positives here. Strong fourth quarter profit and revenue. What were the key drivers?
Yeah, absolutely. And to be honest, continue to build in backlog continues to be extremely impressive. And I think ultimately, we're getting obviously to the tail end of LSTK projects. So, I mean, that's fixed price stuff that has been hurting the company for the last couple of years. But, to be honest, the market has turned the page on those things for a while. And right now it's all about defense, obviously nuclear, and just overall growth outlook for the company and for the industry that remains to be extremely supportive. Obviously, there's been a bit of a dislocation when it comes to AI. I mean, which is a big debate right now in terms of if it's beneficial or negative for the industry. We do think that it's at worst case probably neutral, especially in the short and medium term. But overall, I would say, as you correctly point out, it was a beat on the quarter and a couple of question marks around the outlook. But overall, we feel extremely bullish at these levels. And it's interesting as well how the stock has been reacting. It opened down almost 10%, and right now, obviously, recovering pretty nicely as I think investors are digesting some of the more positive dynamics that came out on the conference call.
All right, let's talk a little the negative, but you think it's clearing out now. The LSTK, where's that going, and what gives you optimism about it?
Well, it just the physical projects are being completed. So Eglinton is operational. The only one large LSTK project which is left is in Montreal, which is REM. And overall, just the sheer size of those losses pales in comparison to the overall profitability of the company. And so I think it's important to kind of de-link materiality of those drags versus the upside momentum which the company is experiencing in the rest of the business. Because, I mean, ultimately, engineering services actually produced 8% organic growth, which was more than double vis-a-vis the peers who reported their Q4s. So that's the positive side on the engineering side. And obviously, we can talk about nuclear, which I think presents a huge re-rate opportunity down the line for Atkins.
Okay, just quickly with the engineering, 8% organic growth, where's that coming from? What are they doing right?
It's pretty broad based. I mean, Canada is very robust. UK remains to be very strong, driven by water and defense. US was actually flat, and we had easy comps in the Middle East. So the combination of sort of all these factors makes for a pretty robust outlook.
And then extrapolating, how is it looking like that could continue?
Yeah, absolutely. So the company is guiding right now to 5 to 7% organic growth, which is kind of in line with what the industry is suggesting. It was a slight step down versus 8% that the company telegraphed a number of years ago into 2027. But I think it was just anchored to somewhat more buoyant environment, which has shifted a little bit. But I do believe that that mid to high single digit revenue generation opportunity is still very much intact, as is the case for the entire industry, to be honest.
Okay, and let's talk nuclear now. 29% jump year over year. Can that continue, or are we hitting a ceiling?
No, it will continue, actually. And the reason for that is because backlog is up more than 50% year on year. And what's interesting, actually, and I think management did a very good job on the conference call, parsing out the 2027 outlook and the fact that any potential new builds, i.e., OPG in Ontario and a potential opportunity in Poland is not part of those estimates. And we actually published a note a number of months ago, parsing out how valuable or material it could be for Atkins when it comes to the Ontario build out. And we're talking about 3.5 billion cumulative EBIT if all of these things go ahead, and that's not including Poland. And that compares to 1 billion EBITDA that the entire company is generating right now. So, and I think obviously there is some speculation around, the technology which is going to be selected or not for the Ontario projects. But given the fact that its supply chain is already set up for CANDU, all of the large nuclear reactors operating in Canada are CANDU. It's also heavy water and unenriched uranium. So we do think that Atkins is in the driving position to potentially, capture those massive opportunities.
And you've got your price target at 110.
Actually, we just bumped it. We just
okay.
published our updated notes, so it's up by $3, and that's the reason why why doing this, because again, like of that improved visibility, despite the fact that there's a bit more drag in LSTK, it's becoming less material. So net, and that's also the reason why the stock is coming back in a pretty weak tape. That people are coming to the same conclusions actually.
All right. Any challengers out there to it?
No, I mean, Atkins is a very unique combination of assets right now. The engineering space is obviously right now being led by WSP, which is the largest engineering company on the planet, another Canadian champion, obviously Stantec out west. But what differentiates Atkins relative to everybody else in the space, which does pure engineering, is the fact that 21% of companies' top line is driven by nuclear, and 37% of the NAV is driven by nuclear. So if you're trying to play nuclear and engineering, Atkins becomes a bit of a de facto play from our perspective.
Okay, we have to wrap it up there, but Max, thanks as always for joining us.
My pleasure.
Max Sytchev is Managing Director at National Bank Capital Markets. Up next, Prime Minister Mark Carney has landed in India to kick off his latest overseas trade trip. We'll get more on that when we come back. Prime Minister Mark Carney is in India, where he will continue his government's ongoing efforts to reset a fractured diplomatic relationship with Prime Minister Narendra Modi's government. For more, we were joined earlier by our colleague at CTV, Jeremy Sherrill.
This first stop is in India, then the Prime Minister will travel to Australia and Japan, but there's much focus about the India portion of this trip. It is the lengthier portion of it, and what we know is that Canada and India have agreed to work towards an eventual broad-ranging trade agreement. It's not expected that will be finalized during this trip, but we do know that a lot of work will happen. This first stop is in India, then the Prime Minister will travel to Australia and Japan, but there's much focus about the India portion of this trip. It is the lengthier portion of it, and what we know is that Canada and India have agreed to work towards an eventual broad-ranging trade agreement. It's not expected that will be finalized during this trip, but we do know that a lot of work will happen to kind of get the ball rolling, if you will, on making progress toward that eventual trade agreement that the two sides are looking to work towards. Mm-hmm. We're talking about two nations in Canada and India that are looking to diversify, especially in the face of changing relationships with the United States. We know that themes of interest between the two will be energy, education, tech, crime, and immigration. We know the Prime Minister will meet with Narendra Modi, the Prime Minister of India, on March 2nd. And we know that specifically when it comes to energy, there is a great interest there from the Indian government to look and try and find a new energy market to import from. When we look at where India is getting its energy from, most of its energy, its oil, where it's importing oil, especially from, it is getting most of its oil from Russia. And India is under immense pressure, especially from the U.S. administration, to stop getting its oil from Russia. And of course, Canada is looking for new export markets for some of its energy products. So there is a natural, connection there, if you will. And I think we can look for multiple memorandums of understanding to be signed during this trip. But both sides are certainly looking to bolster the trade relationship and looking at avenues in which they believe there is room for cooperation and collaboration down the road.
So the government says India has dropped its policy of murders in Canada. Well, I'm being a bit facetious, but one killing, of course, they were linked to. In Canada, the Sikh community has spoken out here. Wants the government, it says, to take a firmer stand on India. Can you give us a bit of context there?
Yeah, look, Andy, despite everything we just talked about, there are significant challenges, of course, and serious challenges in, reigniting diplomatic relations with India. The first being what you just referenced, which is the killing in 2023 of a Sikh activist, Hardeep Singh Nijjar in BC, which the RCMP and former Prime Minister Justin Trudeau have linked to the Indian government. Beyond that, the RCMP has identified just last year, as recently as just last year, that India is one of the main perpetrators of foreign interference and espionage. Despite all of that, what we heard in the lead up to this trip was a senior government official in a briefing with reporters say that, in fact, Canada believes that India is no longer actively taking part in those kinds of activities, and that if that were the case, that the Prime Minister probably wouldn't be going on the trip. Yeah. That has sparked pushback. The Sikh community in Canada is pushing back and asking the federal government to clarify its stance on whether or not they believe and continue to believe that there is a level of threat from the Indian government when it comes to some of those things, transnational oppression, certain crimes that they've been alleged of. What we have not seen yet, Andy, is an official response from the federal government, from officials, and I mean elected officials, the Prime Minister or ministers, because this came from a senior bureaucrat, not an elected official. We've not heard definitively, the government back up that statement or deny that statement yet.
All right, CTV's Jeremy Sherrill. Market calls coming up next. Today on the show, we have Brian Madden. He is Chief Investment Officer at First Avenue Investment Counsel. He will be taking your questions on North American equities. Let's take a quick look at the markets, see how they are doing right now. Bay Street, after a booming week that saw it set 3 record highs this week, I think the fourth, actually, too, is having an off day right now, down by about 0.6. And tech is what's dragging it down. It's down 2 3/4 right now. And that is where we're seeing the big hit. Quebecor is one of the winners right now. Tamarack Valley Energy as well, also up. And Chartwell are some of the movers going in the positive direction. Heading over to Wall Street right now. And you can see they're all in the red and struggling right now. The S&P 500 off by 0.55. The Dow by 1.16, and the NASDAQ by 0.82. And a quick look at 3 companies that we've been talking about all morning with the news that Netflix is bowing out on buying Warner Brothers. That means Paramount is in. You can see Netflix is up 10%, Paramount 18% up, and Warner Brothers off by 2%. Thanks for watching Morning Markets. I'm Roger Peterson. Have yourself a great weekend. We'll see you on Monday.